My name is Adam Levine. I'm one of the managing partners for Levine Capital Management. We're a private equity firm. Our main focus is only investing with institutional quality sponsors, where this is a way for us to really preserve our family capital. And just a little background on myself. Give me 1 second, please. Let me just uh, let me just share my screen real quick. Oh, do we have my? Do you guys see my screen right now?
Yes.
Yes.
Okay. Let me just give it to you right now. All right. So give me 1 second. So basically, I started off in my career where I was really influenced from my father. My father, he's a retired dentist. Fortunately, he was able to retire over 20 years ago, private practice as a dentist. And he was always active investing, buying properties. And later on, about 8 years ago, he really wanted to retire and not be active. I mean, granted, he had property managers, but you're still active when you have property managers. So his goal was to be more passive. Um, so he basically he relies on me because I'm very educated. I have a master's in real estate property management from Drexel University, and he started investing on his own. He made some mistakes on his own, and now he relies on me because of my education to vet the sponsors that he invests with, to vet the deals, and it's a really interesting story. So what he does is I was able to create a hard money lending company in 2018. There's a way for us to create liquidity for our capital, co-lend with institutional investors. And later in 2019, I created a new platform for our private equity, for our real estate holdings, to basically allow investors to co-invest with us. I met Daniel. I know him for about 6 years or so. And Daniel comes from a very interesting background, and I'll let him take it from there.
Hi guys, I'm Daniel Edrei. I am the managing partner for TCS Anika Homes. Just to give you a little bit of background information on myself. So I was over 20 years a bridge and mezzanine lender for a company called Corp Capital Markets. It was a family company. With the downturn of the economy in 2008, something very interesting occurred to us. So on our kind of hard money bridge loans that were below 50% LTV, we had all kinds of problems. We had all kinds of workouts, and they were very problematic. Whereas on our mezzanine loans, where I was loaning up to 90% of LTV or LTC, we had very few problems. And the reason why we had very few problems is, number one, we focused on the best sponsors in the best locations with the best real estate. So I learned very early on that at that junction that a sponsor was one of the key components to the success of a project. I moved to Philadelphia a couple of years ago. I actually moved just to be a good husband. My wife had started a version of Keller Williams called Black Label Luxury International, and had partnered with Ben Aller and Gaurav Gambhir. She was driving back and forth from New York, and it was crazy. And so I said, listen, I can do what I do from wherever as far as investing in real estate, from either JV equity or what have you. Let's move to Philly and let's see if, give you the opportunity to really take this company to the next level. So we moved to Philadelphia, and one night we were out to dinner um, with Ben Aller and the wives. And Ben Aller said something to me. He said, I have been building through TCS investments, SFR units, buying, building, renovating, done about 650 of these for third-party investors, and I feel like I'm leaving all the money on the table, and I want to be doing it myself. And so, to which point I said to him, well, look, this is a very interesting segment of the business, and why don't we JV together and do it? And that's when we formed TCS Anika Homes. So TCS Anika Homes is focused on if you go to the next slide, primarily workforce housing. One thing I learned early on working with Me Corp, the last deal that I did actually was at Me Corp was for a condo developer in New York. And interestingly enough, we had these 4 sprawling penthouse units, and one of them sold for about $20 million, which was $4,300 a foot. The next one sold for like $3,800, all off plans. And this was in 2016. And by the time we sold our last unit, it was January of 2018. And that unit sold below $2,000 a foot. And it was just as good as any of the other penthouse units. So from about 2018 onward, I decided that I didn't want to be in luxury right now. We saw that the writing on the wall, we thought that there was a correction coming. And when a correction came, similar to my experience in 2008, I didn't want to be sitting in the luxury demographic. I wanted to be focused more on workforce housing. And from then on with my company, Anika Equities, which I started shortly afterwards, I focused entirely on workforce housing when it came to any kind of multifamily investments. TCS Anika Homes is, from that point, also focused on affordable housing. It's a segment of the population that we really like. One of the reasons that we like workforce housing and affordable housing is it's really difficult to build new for it. It's hard to make the numbers work with the lower rents. You would be building to a very low cap rate, and it's just not that attractive from the perspective of new development. So there's not a lot of supply, and there's always a lot of demand. The other thing that we noted was that in the SFR world, in the markets that we're at, the occupancy rates are very high. Tenants are staying a minimum of 2 years, often longer than that. And there is continuous rent growth. So we actually used to be focused on Section 8 housing. We've since gone to free market because here in Philadelphia, they lowered Section 8 rents. It used to be about 30% higher than market. They lowered it to market. So for that reason, we're now only doing free market rent type units. And we found that it's pretty easy to grow our income about 3% or more a year, especially in the markets that we're invested in. We also, as I noted before, feel that the affordable housing is really recession resistant. So on your kind of $1,200, $1,300 rent SFR unit, you're always going to have a tenant for it. It's not nearly as volatile as the kind of more luxury product. And we feel that when things go wrong, when there's a correction in the market, there isn't a lot of volatility. There isn't a lot of, rents are not going down. They're staying stable and even continuing to appreciate as people from kind of better units move down into workforce housing. So why SFR? I have been investing in multifamily for many years. With SFR, one thing that I really enjoy is I'm buying SFR units and building to an 8 to a 10% cap rate, whereas on multifamily, I might be half that if I'm lucky. If I'm not in New York, and then maybe I'm at 2 or 3%. So the cap rates are much higher. The levered returns are substantially more interesting. The other thing that we like is that it's very simple through the Burr method to go in and repatriate equity through a refinance early on. SFR, by the way, for those that don't know the term, is single family residential. But in any case, so we found that you can repatriate equity very quickly through the Burr method. Oftentimes you're getting 100%, sometimes you're getting 110% or even better of your equity back within the first year. So it's really interesting on an IRR level. It's interesting in that once you repatriate your equity, you can then invest in another, batch of units and just exponentially grow your income. The one other thing that we like about SFR, particularly in our market, is that there are not a lot of institutional investors. A lot of what we're competing against are kind of mom and pops that have a few units here or there. There certainly are now, since the downturn of the economy, with groups like Invitation Homes and Amherst, some very large institutional investors. They're not yet in Philadelphia. So we are, really trying to make an impact as an institutional level investor here in Philly and in some other markets that are strong markets for affordable housing. The other thing is that, it used to be SFR is now an institutional kind of asset where it never used to be. And this happened kind of in 2008 and 2009. All of a sudden, with, groups like Colony or with Blackstone, there began to be some liquidity in the asset class. When I talk about liquidity, I'm talking about debt being available. I'm talking about, equity, institutional equity, focusing on this type of asset class. It became an institutional quality asset class. And that's, enabled us to take this business plan and make it into a scalable business.
Yeah, one factor that I want to mention as a lender, and Daniel did hit a great point. There are so many different types of lenders out there. Now, we could buy portfolios of SFR, and we could take on a portfolio loan. And this is something that is very new. Another factor is that we could also obtain non-recourse debt similar to multifamily loans as well. And I see this as a lender myself. So this creates lots of liquidity for us.
No, absolutely. And for me, as you know, a guy with my background in commercial real estate, it was very important for me that I don't sign PGs on everything that I do. So having non-recourse debt available has really made it, you know, interesting for us. Now, why Philadelphia? Philadelphia is interesting, specifically for affordable housing, because a large segment of the population, almost 26%, is living below the poverty line. So there is an enormous need for affordable housing, for workforce housing. Philly is a great market for that. As you can see in the slide, nearly 400,000 residents fit that kind of moniker. So what are we doing? Standard project that we're doing is we're going in. Initially, we were doing complete gut renovations where we would replace, you know, just about everything. We would keep everything but the exterior walls. Now we change our focus a little bit, and I'll talk a little bit about why a little later, but we changed our focus to do a little bit of an abated renovation. We're buying rented units, and we're replacing the roof, the windows. We are replacing the floors, the kitchen cabinets, the appliances, the bathrooms, the tiles. We're upgrading HVAC, and we are upgrading the electrical boxes, but we're not tearing open all of the walls and replacing all of the mechanicals. And we found that that model enables us to buy already rented property at a little slightly higher price going in. So just to go over the rules of thumb here for, you know, that we're typically looking at, 3 to 4 beds under $70,000 purchase price. Now we're trying to do a lot better than that. Property condition, either a light renovation or a full gut renovation, and the purchase price would be very determined by the level of renovation, of course, that's required. As far as cap rates, we're looking ideally over an 8.5 cap. The ARV, which is the after renovated value, minimum at 135,000. We're looking at buying units, ideally in portfolios, where there's 6 months or less remaining on the leases. That way we can go in and we can renovate and we can get higher rents. And our total projected cost should be at 80% or lower of the ARV. You know, there's a thing in SFR called the 70% rule. We found in a lot of the markets that we're in, which are kind of lower priced markets, 80% is a number that works, especially seeing that we are a long-term, a long hold is what we're looking at. So we can go to the next slide.
Wait, right here. This is the neighborhoods right here.
Okay, do you want to go back to the pictures?
Yeah, sure. This is, yeah, we can talk about the
okay.
product.
All right, I'm sorry, before for the neighborhoods, it's fine. So this is just an area, a picture of where we're primarily focusing right now. These are neighborhoods which have a need for workforce housing, for affordable housing, but which also have some proven after renovated or after repair values, so that it works for our debt, so that we can, you know, in align with the Burr method, repatriate as much of our equity as possible early on when we refinance. So we can go to the next one. These are just some typical you know, ideas of your photos of units, kind of what we're doing. Now remember, this is a $1,200, $1,300 3-bedroom, 4-bedroom apartment. So what we're doing is we're doing a very nice, high quality product for a very low, you know, demographic, for the lower income demographic within primarily right now West Philly, Southwest Philly. Also, we're venturing now into North Philadelphia and some other areas. Wherever we can buy for the right price and build to a minimum 20% profit margin, we will entertain. You can go to the next slide. So the first deal that we did was Fund 1. This was when I mentioned, we spoke, Ben Aller and I, about JVing together and doing this with Anika as a GP. We did it all equity at first because I didn't want to initially take the risk of, you know, putting a lender in a first position. So we did an all equity fund. It was about $1.5 million. It was our test fund. With it, we bought 12 units. We wanted to verify that, you know, our acquisition costs were what we thought we were, that our build time, that our renovation costs, that our after repair value was what we were hoping it was going to be. The target IRR was like a 21%, which was high. We didn't quite hit 21% on that because we took a little longer to purchase, and I'll speak briefly about that. So one thing that we found for this fund, we were buying properties that were vacant, that were total gut renovations. These were properties that were in horrific condition, some of them. They certainly weren't in livable condition. And what we found is that we were competing with a lot of fix and flippers, guys that were doing what's called lipstick on a pig. And whilst we were doing a full gut renovation, it was difficult for us to buy at the right price. And it took us a long time just to buy 12 units. So one of the lessons learned here was, number one, that we needed to buy, you know, look to the market where there was more availability, and that would be properties that are already rented. We found that already rented product, there was a plethora, this much broader pool of properties. And so it wouldn't take us so long to go through our acquisition phase. We can go to the next slide. So after Fund 1, what we found was that we checked the box on all of our underwriting assumptions, except for the one about the time frame for the purchasing, for acquisition. We went out and we decided we needed to get some debt. We interviewed at least maybe 24 different lenders. As I said before, there's a lot of liquidity in the market. There's a lot of different lenders. What we did is we picked our best, which was with Corvest. They gave us non-recourse financing, a $15 million line of credit, which could be scaled larger very easily. I like Corvest because they used to be Colony Capital and were one of the kind of initial players in 2008, 2009. So, you know, these were one of the longer time players in the market. But to give you an idea, so we got a small group of properties. We bought 15 units, but we did them all at once. It was all within the first couple of months that we bought a portfolio of 11 and then 4 different properties individually. Our average purchase price here, these were rented units primarily, at about 69,000 per unit. The renovation budget again was slightly abated. It was 53,000 per unit, whereas the previous was closer to 75. And we were looking for ARVs at about 150,000. Target IRR for this fund was 22.1% with a 1.73 target equity multiple. To give you an idea, IRR, by the way, for those who don't know, is the internal rate of return. The target equity multiple is the multiple that you're getting on invested equity, meaning with 100,000 invested, we're expecting to return over a 5-year hold 173,000 to that investor.
And actually, I wanted to mention too, this is the first deal that Levine Capital invested in. We invested as a limited partner, 150,000 with Daniel, and this is a very interesting deal prior to COVID-19, and we're doing good. You know, obviously there's delays and stuff, but we're in a good position with this deal because of the purchasing we came in and the sponsorship that's managing the deal.
Absolutely. So to give you an idea on this fund, it was about 600,000 in equity and about 2 million in total capital. But we got the lion's share of that through CoreVest. CoreVest was investing 80% of the initial acquisition plus 100% of the renovation, not to exceed 70% of the ARV. So that's where we were on that one. And then Corona hit. I was ready to launch a large kind of at least 100-unit fund, but Corona hits and the world, as you know, came to a complete standstill. We were trying to, we were probing into the market to see what would happen. One thing that we found was that there was a lot less liquidity in the market. So a lot of lenders backed out, a lot of equity players backed out. People didn't know how to handle Corona. They didn't know how to handle loss of work. There was a lot of fear in the market. And what we found is that put us in a prime position to buy at a significant discount to what we could a few months ago. So with 40 units that we're closing Fund 3 in a couple of weeks, 2 to 3 weeks, we will purchase 40 units with it. We raised about $1.5 million in equity. It's about $5 million in total cost, with the lender taking the lion's share of that. The purchase price is about 52,000 per unit, we're finding. So that's kind of 25% below what we were buying a few months ago, which was, closer to 67 to 69,000 per unit. The renovation budget is about the same. We increased it a little bit to ensure that we get the ARVs. ARVs at 150,000 per unit, but you can see, because we're buying significantly cheaper, you can see that the IRR here is through the roof. I mean, it's 40.8%, and the equity multiple is almost a 2.1x. Again, what that means, with 100,000 over a 5-year hold, you're expected to get 210,000 back.
All right. So this is why investing in a fund, and there's a lot of factors to investing. And one reason is when you buy, for example, people talk about multifamily, you have many doors, and if there's vacancies, you still have cash flow, right? Well, guess what? We're buying portfolios of single family rentals where it's very similar to multifamily. And Daniel could explain more of why investing in a fund is actually more advantageous than a syndication.
Well, so there's a couple of obvious reasons. The first is when you invest in a fund, you're investing passively, which means that you don't have to be out there looking for properties, overseeing the renovations, leasing to tenants, dealing with a 2 a.m. problem with a plumbing issue. You're completely passive. You have a sponsor that has been vetted. In the case of TCS Anika Homes, it's interesting from the perspective of the sponsor because we have vertical integration. We're doing everything. We're managing. We're building. We have one of the largest Keller Williams in Philadelphia with 500 agents. So we're kind of vertically integrated. The other thing that's really interesting about investing in a fund is whereas in real estate, there's always going to be occasional problems. It's going to happen. Murphy's Law, I think, was written for real estate. You're always going to have a property that goes over budget, that you find, extraneous problems that you didn't expect initially. You're going to have a bad tenant happen. You're going to have, issues on 1, 2, 3 properties. You're never going to have issues with 40 different properties. So what that's doing is, the better performing properties, the on budget properties or under budget properties are carrying the ones that are over budget or that had other problems. So, you're diversifying your investment to a pool of properties instead of one at a time. So, you very much diluted your concentration risk. The other thing that's interesting about investing in a fund is whereas, smaller investors can invest in a large amount of properties, which you wouldn't normally be able to. So, with $100,000, $200,000, that might buy you one property if you're doing it by yourself. When you invest in a fund with a great sponsor, you can have a piece of 40. So, and the other thing is that when you have a relationship with a good sponsor in a fund, is you have the ability to roll repatriated equity that comes back to you in a refinance into another fund right away. And that's how you exponentially increase your returns on your own equity. So, next.
Yeah, so this is something very important that Daniel and myself could really touch on. We both have very similar backgrounds. The only difference is Daniel's been doing this way longer than myself. But so as a passive investor, you really need to know how to vet sponsors. And there's a good quote right here. It says, most important, before looking at the other ideal is, good operators and sponsors turn bad deals into good ones, and bad operators and sponsors turn good deals into bad ones. And what I realized was, and what Daniel realized was, is that really you want to look at the sponsor first before looking at the deal, because looking at the deal could be a complete waste of time if you don't have a good operator in place. And what we look for Levine Capital is someone like what Daniel was able to put together. Vertical integration, meaning they control everything in-house. They have the management company. They have the construction company. We're not talking about a mom and pop management company. We're talking about the largest scattered management site company in Philadelphia. They manage over 3,500 single family rentals. They have a proven track record. They've done this over and over again. Daniel, you could touch base on what you did prior with the originally TCS Investments.
So yeah, like Adam was saying, you have a sponsor with TCS Management, which is the management firm, is focused primarily on affordable housing with 3,500 units. They're the largest scattered site management company in Philadelphia. You have TCS Investments, which is our GC arm, which has built over 650 of these. You have Keller Williams Philadelphia with 500 agents. So we have access to a lot of off-market opportunities that you wouldn't normally see. And you have TCS Anika Homes, the development arm, with an enormous amount of experience as a developer, as an investor, and so on.
And another important thing is the financial strength. Daniel was talking about CoreVest with a $50 million line of credit. No one's it's very hard to get that. I mean, they're looking at everything, your financials. They want to see, your track record, experience. For someone that doesn't have experience or financials, they would never be able to get that type of line of credit and with the same terms that they have. We're talking about economies of scale. What Daniel and his team are looking to do, regular people cannot do it efficiently with the operational efficiencies. They manage, like you said, 3,500 of these. They have the construction company, so they could do things cheaper. They can manage things cheaper and handle construction and maintenance cheaper than the normal person looking to just start this. And another thing is, Daniel, whenever...
That's another point, Adam, let me interject there. So, for example, on the management side, TCS Management typically gets 7 to 10% management fees. With investing with us, they're getting a 3.3% management fee. It's fixed at $40 per month per unit. The other thing is, our GC arm is getting a GC fee of $7,500 per property. And that's about 15% of the budget. And, typically when you're going to a GC, he's going to look for at least 20, 22, 23%. So you're saving in that regard also, because we have everything under one house. Sorry, Adam.
Yeah, no problem. Please, this is your baby that you're growing. Another thing is like I mentioned, was Daniel, he would never been able to start this. He would never consider starting this unless they had the right infrastructure in place. And since they already have the construction and management company, that's why he was able to even consider creating this new company, TCS Anika Homes. And that's very important. This is not something simple where you could just decide tomorrow, okay, I'm going to want to acquire, renovate, and open up a REIT. And it's not a very simple process. It takes the right infrastructure.
And that is an interesting point, Adam. The long game here is to collect thousands of these units, and eventually, instead of dealing with independent lines and smaller investors, to go public and open up a REIT. We would very much like to be kind of the, following the Blackstone Invitation Homes model, of affordable housing.
And what's really interesting too, I just want to go back, is that during this whole pandemic, the SFR REITs actually, they managed very well. And this is very new that was created during the last recession. And what's really interesting is, technology, years ago, it was very hard to even consider managing single families, scattered houses. But now with technology, it's easier, and if anything, the technology is even it's going to improve as this industry starts to mature.
Yep.
Sorry about that. So now is really the opportunity to invest. What's interesting is that, like what Daniel was mentioning, pre-COVID, the pricing was good, but now the pricing is much better. And one thing to consider is we don't know how long this short-term distress opportunity is going to last for us. So instead of playing defense and sitting on the sidelines waiting, we want to be offensive. We already know what our dollar amount, we already know our numbers. And right now we feel it's the time to go in because, we're very, it's an opportunity to buy at a discount, but we're very bullish on the long-term fundamentals because if anything, there's already lack of supply for affordable housing pre-COVID. And if anything, later on down the road, there's going to be more need for it because there's going to be less buyers able to purchase a house. There're going to most likely be more renters. And there's most likely going to be more people downsizing from a higher end rental, such as Class A, and they're going to move into workforce housing. And Dan, did you want to add anything onto this as well?
No, I mean, I think those are all good points. It's right now is the perfect storm. Look, Invitation Homes, which is a $17.5 billion company, started off in 2008 and 2009 buying an enormous amount of properties at a significant discount. It's often said in real estate that you make money on the buy side, not on the sell side. So it's a perfect storm.
So this is something that, like what I mentioned from prior about my background, we just started allowing investors to invest with us. We only want to invest with institutional quality sponsors like TCS Anika Homes. When we're talking about institutional quality, we're talking about they have everything, like I said, in place. Plus also they could take on institutional capital partners when they grow in size, meaning some of their investors could be a pension fund or sovereign wealth fund. These are very sophisticated investors. They won't just invest with anybody. Another factor is I wanted to create something for people where people do not have a few $100,000 to invest. And what ends up happening is they're forced to invest with less quality sponsors. I mean, you could go look at your local REIAs, crowdfunding sites, and there's a plethora of them out there. For me, I'm very comfortable with Daniel and his team. And what I want to do is I want to aggregate capital to create club deals where we're bringing down the minimum investment from $200,000 to $25,000 minimum. And another interesting thing that I realized is that I have Tay on here. Tay is he's a ex-Goldman Sachs analyst for over 5 years, CPA, CFA. He used to work for Prudential. He came to me because he wanted to invest, but he also wanted to learn. So what I realized I could create a platform with an institutional quality sponsor, and generally these sponsors don't have time to educate. They don't want to. It's just not in their. It's not their goal. I was able to make a deal with Daniel. Say, hey, let me bring down the minimum investment, and let me create an educational platform. So I brought in Tay in, and Tay can tell you a little bit more about what we're doing.
Yeah, okay, so yeah, let me share a little bit about how I became involved and my experience about this journey. So around 7 years into working in finance, I became really eager to try something new by leveraging my finance background. After profound soul searching, I've come to the conclusion that real estate can make my life more fulfilling by basically allowing me to help literally anyone, as everyone can relate to housing as a human basic need and make a meaningful impact on the community and society, and also take a further step to building wealth for my family and helping people around me. Then I started attending many real estate meetups and met Adam in one of the events, I think a couple of years ago, yeah. So we hit it off right away and ended up talking for an hour. So he has since been genuinely helping me and sharing his insight whenever I had real estate related questions. Then last year, I learned he was establishing this SFR multifamily investing platform. The timing couldn't be better, actually. So I just finished reading a book on multifamily investing, and got drawn to the business plan. And after doing my due diligence, I decided to get on board in Fund 2 as a limited partner. And I love the whole experience because what I truly appreciate is the opportunity to get involved in the overall processes and access to constant updates and communications with Daniel and Adam here. So I used to get stuck in what they call analysis paralysis. And now I feel like I overcame the hurdle finally to some extent. And although technically I'm a limited partner in this deal, I don't feel quote unquote limited. Rather, I'm empowered to get my questions answered timely, analyze deals at a high level, share my feedback, and in turn, learn many underlying aspects of multifamily investing. And as Adam mentioned, with the Facebook mastermind group and periodical Zoom calls, investors stay connected with the operators and informed of what's going on, which is very crucial to me personally. So I believe investor can definitely gain as much hands-on experience and knowledge as you wish by participating in such discussions. And all in all, my experience with Daniel and Adam is extremely positive, and I'm so glad that I made the decision in the first place.
Thank you, Tay. And another factor is Tay, I brought him on board due to his experience, his education, to help me grow this mastermind community. So we're both going to be there with you, learning, like we're learning ourselves, and we want to learn with you. And we're going to invest together, and we're going to learn by monitoring our investments together. And another thing is, we're always invested with you. I mean, myself, Tay, Daniel, we're always going to have our own skin in every fund. This is very important. This is very important to us. That being said, we're patient with our capital. We're not just going to throw our money into a bad deal. And wait, sorry. Give me 1 second. My apologies.
I think that's it, Adam.
Yeah,
open up for Q&A.
Yeah, that's where we're at. Q&A right now. That's where we're at right now.
All right, guys, can you hear me? This is Seti. Really great presentation. I really enjoyed it. And we've got a whole bunch of questions for you that I'll be reading them out. But I just wanted to say it's very interesting. Your model is literally like 98% of the model that Jay and I have been using in Scottsdale real estate investments. So we'd love to get together with you after this and figure out some synergies.
Adam, maybe stop sharing so we can see whole faces.
My apologies. This whole new Zoom thing is very...
Yeah, we're all adapting to how to use this, and you know, it's a little bit difficult, but it's fun. You know, it's real, it's authentic, and by the way, we have an educational platform too, so it's pretty.
Oh,
simple.
really?
Yeah, totally. We'll tell you more about it later. So, okay, first question, super simple. Can you guys hand out slides to people? Is there a way for people to connect with you to get slides?
Sure. I could. The slides I was just sharing, I could absolutely slide out, no problem.
Okay, so for everybody, if you want to get slides from these guys, just send your emails, and I'll pass that on to Adam so he can get in touch with you and get you that information. Okay, as you guys were going through your presentations, you went through Fund 1, Fund 2, Fund 3, and in the middle of that, there was a question about, is it an all cash investment or are you doing debt as well, and how does that work?
So again, since from Fund 2, we have a very good relationship with CoreVest. We like debt, we like the leverage, we like the positive leverage, even better. And that's how you get to such high IRRs and equity multiples, is by utilizing a debt product.
And what leverage level do you guys go in at when you're doing your acquisition, and what do you use as your target debt level after that's all done?
So typically we are buying with anywhere between 70 and 80% of the initial acquisition in debt, and then up to 100% of the renovation, but not to exceed a combined cost of 85%, say 90% at most, and not to exceed also 70% of the ARV.
And then as a follow-on, do you wait a certain amount of time to do a cash out refi, or do you just try to bring debt levels down and change your financing at some point from acquisition to more longer term?
So one of the reasons why each one of the funds are like these small groups is because with our line, we can't have a bridge and a refi in the same borrower. So the expectation is almost always within a year to be able to repatriate usually 100% or better of the equity. So you're getting all of your initial equity back in the first year, and then you can take that money and roll it into another fund or some other investment, and really get your return on equity to exponentially grow.
Great, terrific. So the next question is, what is the timeline from the time you're acquiring the properties to all cash back to investors? I think you may have answered that, about a year cash back, and you're basically doing a refi at that point and bringing the equity out. Okay.
Correct. There's initial cash flow off of the unrenovated units as well as after we renovate, but the main the bulk of the equity that you're getting back is through the refinance, which is happening within a year.
Right. You guys mentioned CoreVest. We use CoreVest as well. Are there other lenders that are that you're using? And what lenders are lending on $52,000 properties? We've come up against some issues with lenders that if the value is somewhere around 50, they really don't want to do the financing.
I could take that. So I'm a lender myself. CoreVest is great. I mean, they're backed by Redwood Trust, which is a REIT. So my company, Arca Capital, we can lend on the smaller $50,000 properties. We could do that. But by all means, if you throw your email in the chat, I could send you our guidelines of what we could do. We could also be very creative as well with our lending. We do require personal guarantees, but and we don't have a lot. And the line of credit that Daniel has from CoreVest, we don't have yet, but hopefully in the future we'll roll that out eventually as well.
Right, and you could use your financing for acquisition with recourse debt, and then as you're putting in your renters and you're bringing in your equity, and you move to a new loan, let's say for like an amortized long term after the properties are stabilized, you can get the non-recourse at that point. So there's like more of a short-term risk period.
Yeah, I mean, and the goal is to is to choose the best lending. Obviously, I would love to lend with my company, but CoreVest, they offered more attractive terms with their bridge debt. And then when the time comes, we'll have multiple options with the permanent financing. We go to agency route, we go CoreVest. We already identified multiple lenders, so we're not stuck to just one lender, and it helps us with our underwriting as well for the future cash out refinance.
It's interesting to know, like we were saying, there's so much more liquidity in this asset class now. If you were looking in 2008, you might have found one or two lenders that would invest on this kind of business plan. There's dozens of them now. Granted, we're seeking the absolute best terms. We have very strong financials. We have a lot of experience. We don't want to sign personally whenever possible. And we've been lucky enough to get all of our terms met with CoreVest. So for the time being, we're sticking with them. Should we have to look elsewhere, we're confident that there's a lot of other lenders.
Oh, there's plenty of lenders. There's a lot.
Yeah, there's quite a few. And if people want to find lenders, a great place is IMN. We've been able to connect with a lot of lenders there. And I know Linda knows a lot of lenders as well who will provide information through the Realty411 platform. So there's a lot of questions about investment structure. So let me just throw a whole bunch of stuff out there at you guys, and then you guys can take it there. So what investment structure are you using? Is it Reg D, 506, 506C? Accredited, non-accredited. I think you talked a little bit about that, that you have an investment club structure. So if you could just talk about how the overall structure is and how the money flows in and how you keep everything legal.
So it's got to be it's a 506c. We're looking for accredited investors only. It's self-attesting. So we essentially send out a document which describes under the act what an accredited investor is. And assuming that you sign that and attest that you are one, we don't have to put you under a microscope, but.
And one factor I wanted to mention was we're doing we're doing these deal by deal because we don't want to just start raising money through a fund and then have money sitting on the sidelines. So eventually we could go a route once we know there's enough deal flow coming and enough to take down. And as things grow along, we could always create different structures that later on. And eventually what I'm thinking is too, for non-accredited, I may create, because what we realized was there's actually employees for TCS that want to invest, they're not accredited. So what I may do is I may go the 506B route, and where I could take in up to 35 non-accredited investors. And then obviously I could open that up to other investors here as well. So we're very flexible with the way we could, with the structures that we, for now and in the future.
Okay, great. So the next question, I know the answer to this one, but I'll let you guys take it. So you guys have an IRR that you're showing to your equity partners, people who you're marketing your deals to. Is that a guaranteed IRR, or how do you handle that?
There are two guarantees in life: death and taxes.
Right.
I would say that I have a history of, for 25 years, people have been investing with me. And I try and underwrite very conservatively. I like to under-promise and over-deliver whenever possible. So we hope to exceed, the IRRs that we give. But there is a risk. And it should be that you're using capital that that's patient money.
And another thing,
real estate.
I think another factor is the whole idea is to preserve capital. Like what we learned from my family, my father, he's chasing yield. Gets very attracted to these high yielding, sponsors. But then you end up losing money, and that's not a good thing. So yes, you really want to focus. What we focus on investing is really what's the risk, and really what's our downside risk, and so yes, the IRR is great that we could make, but realistically, are you always going to make that? No. But do we lose money? No. The goal is not to lose money. The goal is to grow our money and really preserve it. So that's just one thing as an investor I really focus on is what's your downside risk? Don't really chase yield because eventually you're going to get burnt.
Yeah, we've experienced that as well. Typically the very high yielding portfolios are in areas where there's lots of turnover. So you're constantly paying your realtors to fill up your renters, and then they're out for, a while. Sometimes you have to deal with evictions. So even though you have this high potential yield, it drops down and it gives you a lot of headaches. So sometimes it's better just to, be in a better environment where you can control that. So on that note, here's the next question. What kind of neighborhoods are you looking at? I know you're in Philly, you're in South Philly. Are these D neighborhoods, C neighborhoods, B? Where do you go and find properties for $52,000?
So really where we're focused on, they're certainly not A neighborhoods. These are, I would say they're not D neighborhoods because there are certain areas that you'll never gain appreciation, or at least not anytime in the near future. There are markets which have proven ARVs, with proven returns. But there's certainly, they're B minus, they're C plus type neighborhoods. We're typically the nicest units on the MLS when we rent out our product.
Yeah, I gotcha. And are you guys like concentrating in areas so you're pushing value in the same neighborhoods?
Whenever possible, we are. A lot of the way that we acquire is purchasing in portfolios. So I don't always have the ability to control every metric. If I'm buying, 20 off one seller, certainly there are cases where we will exclude some properties that we don't feel fits our investment, model.
Okay, here's a question regarding the properties. Are they titled in their name? How does that work?
So the investors are part of an LLC. They have a percentage of the LLC that is the owner of the borrowing entity, is the way that it's structured. So it's the parent of the borrowing entity. With CoreVest, I need to have another layer with a borrowing entity that's a Delaware LLC with just, one owner. But the parent of that entity is the one which they will have a percentage of the LLC.
Correct. It's like a mutual fund. They have a fractional share, fractional interest within the fund, and the fund is the owner of the property, and they're owners of a piece, a fractional share of the fund. Okay. Does your management company also own part of the fund? The sponsor, I believe, that is targeted to?
Well, put it this way. So the management company doesn't own any of the fund. But the owners of the management company are my partners. Mm-hmm. So, any way you look at it, we're all very invested, in every aspect of the buy and build.
Okay, we've got about 1 minute left, so there's a couple more questions. Let's see if we can get those answered quickly. What is your typical interest rate that you're borrowing at? How long does it take you, the time frame to fund it? So let's say going through the CoreVest process, the length of the loan, and the biggest loan that you've done.
So our last fund, we were getting interest-only financing at 7%, which we feel is pretty competitive, given that they were giving us up to 90% of cost. There may be some tweaks of about 50 basis points or so for the next fund, because with Corona, lenders have, found that they can increase their rates, and a lot of investors have bailed out of the asset class. So we're working on it right now.
But even at 8% non-recourse with a little bit less leverage, it's amazing.
It doesn't make a big difference.
Yeah, it's great. It's great for the acquisition, and then once you get it stabilized, you refinance at a lower rate anyway, which they're probably giving about 5.5 now.
Correct. 12 months down the road, when we're looking to refinance, we'll be in a much better place than we are now.
Exactly. All right, guys, I think we're at 10:15, so we're going to have to call it at this point, but just wanted to thank you so much. What a phenomenal presentation. I just loved hearing everything that you guys had to say and what you're doing. I relate to everything and just can't wait to talk to you offline. And I'm sure many other people within the event are going to be talking to you guys. It's a great future moving in this direction.
Yeah, thanks
very much for the opportunity.
Thank you, Daniel. Thank you, Linda, Tay. Thank you, Sandy. Thank you, everybody.
Thank you,
everybody. Appreciate it.
All right, great. So we're going to bring